This is Tesla, and just looking at the candles, tell me where you'd buy, where you'd sell, where the trade even is. You can't. Nobody can, because price alone is half the story.
Oh my God, the power's out.
What are we gonna do now?
Well, we could light some candles and read.
Read the inside of my butt.
Here's the one idea that changes everything. Regular volume shows you volume over time. Volume profile flips it on its side and shows you volume over price, exactly where the real money transacted.
Right, so what is the VP? The volume profile tells us how many people transacted at a price. But what it allows us to do is get intuition about which prices are stickier or more important than others.
So today, I took 6 Tesla trades, 6
clean.
different volume profile concepts, straight out of the playbook. A balanced D shape, a bullish P, a bearish B, a thin trend, a value area breakout, and the king of them all, a naked point of control retest. Let me show you exactly where each one triggered, down to the candle and the timestamp, and the 2 free TradingView indicators that drew every level you're about to see. This is the ultimate volume profile masterclass. Before the trades, the vocabulary, because every setup is built from 5 components.
What are markets trying to do? And I think again, this is some of the key points of what we're trying to do. Markets seek balance, and as such, it's an acceptance of fair value. This is what the consensus is that product is worth today.
The POC, or point of control, is the single price with the most volume traded, the fair value magnet. The value area is the range holding roughly 70% of all volume, bounded by the value area high and value area low. Inside that, fat bars are high volume nodes, brick walls. Skinny bars are low volume nodes. Open doors, price races through. That's the whole engine. The market drifts away from fair value, then gets pulled back to it. Our job is just to find where the buyers and sellers are stacked and stand with the winning side. It's the invisible force underlying everything.
The Force is what gives a Jedi Knight his power. It surrounds us. It penetrates us.
We are looking to find support and to buy it, and we're looking to find resistance and sell it. That's our sole job. That's the only thing you do. If someone says to you, what do you do for a living? That's what you do. You're looking to identify support and looking to identify resistance. Everything else is just garbage.
Do this once, and you're set for all 6 trades. Indicator 1, your levels tool.
All right, now what do I click?
Click Preferences.
Okay, I clicked Preferences.
Now go to Default Media Browser.
Okay, there's a little hourglass, and it's not letting me do anything. It says buffering. What is that?
In community scripts, search Volume Profile, VAH, VAL, and POC. Click to add. Double-click it to open settings, and enable the VAH and VAL lines plus extend PIOC right, so the line projects to today's price. This is your fast read. It paints POC, VAH, and VAL on any range so you instantly see fair value and the value area edges. Indicator 2, your structure tool. Indicators, community scripts, search, market structure, volume profiles, Kiosef trading. Add it. This one's smarter. It anchors a fresh profile to every shift in market structure, every break of structure and change of character, and it plots POC and value per leg, tracks naked POCs, and overlays CVD, cumulative volume delta, so you can literally see whether buyers or sellers won each leg.
So I was not really making any progress until I came across Mark Minervini's books, and which really, when I read the book, I realized that I was doing something very similar, but I was not looking at the risk side. I was not managing the risk. So the one thing that I took away from that book was risk management, and then I realized that I'm not a trader, I'm a risk manager. I have to manage risk and then just be on the crease, survive, and stay on the crease so that you don't die.
First, the textbook. A D-shaped profile is a balanced rotational market, a bell curve. The POC sits in the middle with a well-defined value area. The strategy is mean reversion, Buy the low end, sell the high end, target the POC. The D went both ways here. Back on May 21st, the 1530 bar tagged 186.87 above value and got sold right back to the 173 area. Same logic, opposite side, but the cleaner trade was the long off the lower edge, grabbing a discarded undervalued asset and buying the cheap edge of the range for a move back to fair value.
Somebody threw out a whole couch and it's in great shape.
Yeah, you put a little Febreze on that, scrub it out a little bit, look great in your apartment.
You know what? I know we have a dangerous job to do here, but I'm taking this. I'm taking this couch.
Watch this. June 11th. The noon bar undercuts the range to 167.41, and that's the low. It holds to the cent. The 1230 bar puts in a higher low at 167.51, and price never trades below 167.41 again. There's your trigger. The June 12th 930 candle reclaims the value area low and closes at 173.94. This is the back inside value signal.
If we know where fair value is, and we know the time frame we're talking about, we know then when price has moved away from that, and therefore whether or not it's like to come back again.
Entry 171, stop 167, just under that 167.41 low, sitting in the low volume air where no one traded. Target 1, the POC at 175, tagged by 10 a.m. up $1,000.
You just looked at this, you'd say, well, if the volume point of control is exactly the same as the mathematical midpoint, indicating that the buyers and sellers always sort of returned, no matter what went on during the day, they all sort of returned back to this zone here, okay, that midpoint. So quite balanced.
Target 2, the VAH at 180, tagged by noon, up 22.50. And if you trailed to 191 the next morning, 5 full R. The D shape gave you the whole rotation. Buy the cheap edge, sell back to fair value.
I know that I can do a mean reversion back into, maybe the point of control, right?
Read the picture from the bottom up. Down at the lows, the profile is thin, a skinny tail. Up top, it fattens into a bulb, and the point of control, the price with the most volume, sits in the upper third. That's a P. Bulb up high, stem hanging down. Here's the part most people get backwards. The thin tail at the lows is the tell. Thin means price spent almost no time there. It ripped through those prices in one direction. Fat up top means price got accepted up there. That's where the trading actually happened. So AP is the fingerprint of a short covering rally. Something lit a fire at the lows, price rocketed up through them, and then value rebuilt higher.
Here's a good example of a volume profile shape that we got here. This is what we call a P shape, right? It's literally just shaped like the letter P. So this is kind of a bullish, right? The auction pushed higher and volume accumulated higher. And so we expect that continuation higher, right?
And now the important line. This isn't really about the shape. The letter is not magic. PBD, they're just a picture of who was transacting where and how badly they needed to. We don't trade the letter. We trade the story the letter is telling. And the P's story has a catch. Short covering is self-terminating. Trap shorts buy to close. It's mechanical and urgent. But once they're flat, that bid just stops. There's no one left to buy. So the P is your alert, not your trade. It says a violent rejection of the lows just happened. What it can't tell you on its own is whether that was only shorts scrambling to cover or real new buyers stepping in low with conviction and defending. Both print the exact same tail. The difference is everything, and you only confirm it one way. Does price pull back and hold?
Where did the market go down to that the buyers came in and said, my God, that's so cheap, I've just got to have as many of those as I possibly can.
Now the real one, and context is the whole game here. Tesla ran way too far in 2024, then spent the first quarter of 2025 getting crushed, sentiment in the gutter, shorts piled on, everyone leaning the same way into the low. This is not a random bottom you're guessing at. It's a maximally bearish, over-shorted stock sitting on a pile of dry tinder. Quick note on how you draw this because it matters. Where you anchor decides the shape you see. Anchor from the capitulation low forward and the P reveals itself. Thin tail down at 214 to 232. The fat bulb of value built up around 243 to 260. Point of control settling near 243. Anchor it wrong and you'll fool yourself, and there's the spark. April 9th, the tariff pause day. One headline detonated all that trapped short interest at once. Tesla explodes higher on 219 million shares. That violent thrust off the lows is what carved the thin tail. That's the P's ignition. But remember, the P alone is just short covering, and short covering dies on its own. So you stack confirmation. April 9th prints a change of character, the downtrend's first real structural break, and cumulative delta flips green. The profile, the structure, and the delta now all agree. This isn't only shorts covering anymore. Someone is taking the baton.
One of these days, I'm just gonna take off and join the rebellion, whether you like it or not.
Over my burned carcass.
So to answer your question, for me, this volume is everything. If I have a stock which is moving 10 million, 15 million a day, it is going to be in my focus list at the top.
Here's the moment that turns spark into fuel. Price pulls back right into the shelf around 222 to 232 and holds. It does not fill the tail back down to the lows. That hold is your proof that accumulation took over from short covering. New buyers defending cheap prices, not just shorts finishing up. That's what makes this sustainable, and that's your entry. April 22nd reclaim in at 228. The thin tail is proof demand is greater than supply at the lows. That's right. Just know what it does and doesn't prove. It proves the lows got rejected hard. It does not, by itself, prove the buying was real. The pullback holding is what proved that. Stop goes at 213, right under the accumulation base, and that 214 and a quarter low. Here's your invalidation, stated plainly. If price loses the value low and starts filling that thin tail back toward 214, the move was just short covering that self-terminated, and the low becomes a magnet. You're out. $15 of risk, 66 shares. Wide stop, smaller size, but look at the runway. Target 1 is the prior high near 272, hit in days, roughly 3R. Hold for the 340 measured move, and it's about 7.5R. The P didn't guarantee the bottom. It flagged the short covering thrust. Then the change of character, the delta flip, and the pullback that held gave you the proof the reversal was real. We're buying the bullish reversal off a beaten down 2025 downtrend, lit by the tariff pause day, not worshiping a letter on a chart. The mirror image, a B-shaped profile, is bearish. Volume concentrated at the highs. The POC in the upper third. Sellers in control. Distribution at the top, often the end of an uptrend. The strategy, short the rally to POC or VAH. The setup, the parabola topped at 488.54 on a bearish rejection candle, then carved lower highs into January. The 442 to 488 tail is the rejected, low-volume, unfair highs. Value sits below at the POC, 422, and price loses the value area low at 387 to confirm the B. Here are the levels. VAH, 442, POC, 422, VAL, 387. The trigger line sits at 403. And the macro picture, a high of 488.54, a low of 275.62, last price 415.11. And the January bounce stalls exactly at the distribution highs, then rolls over. That stall at value is your tell.
So these are examples of what we call weak highs. So what do we mean by a weak high? Sorry? Okay. So what does that mean though in terms of buyers and sellers? What's actually going on?
Buyers trying to push up the price.
Yeah, and what are the sellers doing?
Push down the sell side.
Yeah, but they're not pushing back. What they're doing is they're just sat at that price. They're just saying, okay, we're here. Normally when you get to a high, so people buy a market up or buy any product you like up, gets to a price and sellers go, no, that's wrong, it should be back down here. In this case, people are buying the market up, but the sellers are just sat there going, you can buy as many as you like, but we're just going to sell here. We're not going to sell lower, we're just sat here. We're happy to sit here. So people come up, they start to buy off these sellers, they realise there's more sellers than they can buy off, so the price comes back down a little bit. Then they have another go later in the day, trot, up they go, up to this price. Sellers are still there, They can't break through, market backs off a bit, all those people who bought get out of their position, then later on the day they have another go. And so these are sellers, but they're passive, they're not aggressive, they're passive sellers. And it's important to understand the difference between the passive selling and aggressive selling.
You short the failed rally, the retest into the POC at 422. Stop at 443 above the January distribution highs, $21 of risk, 47 shares. Target 1, the value area low at 387, hit February 3rd, 1.7 R. Then the 328 node, February 11th, 4.5 R. And if you held the trend down to 290, February 25th through the 28th, 6.3 R short. Why it works. Volume profile maps acceptance versus rejection. Fat nodes are fair, accepted price. Thin nodes are rejected. The 442 to 488 tail is rejected supply. Once price fails to re-enter value and loses the val, longs liquidate, and the move extends toward the lows. You invalidate on re-acceptance above the VAH. One caveat, call it honestly. With the POC at 422 sitting in the upper third of value, the static shape leans P-ish, so it's more of a distribution top confirming bearish on the 387 break, not a textbook B on day one. There's an old rule on selling. Either it hits your stop or it goes super extended. That rule, stop or super extended, is exactly how you ride a B-shaped breakdown without choking the trade early.
Selling is the trickiest part of this business. My first rule is when you take a trade, you have to follow this rule. Either it hits your stop or it goes super extended.
A thin profile means a trending market. Narrow, elongated, one-sided. Little time at any price because one side is winning by a landslide. The strategy? Trade with the trend and use the POC as a trailing stop. But let's read this one honestly, because it's not a pure thin profile. It's a hybrid, and that's the lesson. Read it bottom up. At the base, a dense launch coil, roughly 245 to 258, the early November tightening, sitting on top of that broader September to October foundation down near 215. Then, above it, the thin void, 258 to 277, where price ripped straight through and left almost no volume. That void is your real thin proof, the one-sided trend signature, not the body up top, and then higher still, the value shelf, 296 to 353, the November 11th to 15th pullback. That part is fat, a developing distribution, and that is where you enter.
And we expect prices to rip through low value, and we expect prices to seek out liquidity and actually seek out the high value areas.
So the whole story lives on one chart. A thick base below, a thin void, fat value up top. Thick base, thin breakout. And that's exactly how trends move. Price rips through the low value air, then seeks out liquidity, the high value areas above. Here are the levels. 30-minute, look back 118, POC 318, VAH 353, VAL 296. That's a value area width of $57, about 18% of price, a wide value area, exactly what you'd expect from a trending market. Now here's the precision you only get intraday. The pullback low is 309.22. The November 15th 930 bar marginally under the prior day's 310.37. And that same bar reverses hard. It opens 310.84, dips to 309.22, and closes 318.18, reclaiming developing value right at the POC. That's your trigger. The trade. Entry 318. That reversal bar close, sitting right on the POC. Stop 308, just under the 309.22 pullback low. And be precise about that stop. It sits under the pullback low, not below value. The val is all the way down at 296. A true value stop would be 294, $24 of risk. This is the tighter structural version. $10 of risk, 100 shares. Then you let the thin profile do the work, trailing the POC up behind price. Your breakout line, 353 to 358.
Right, strap yourselves in. I'm about to make the jump to light speed.
Did he say strap in or strap on?
The VAH at 353 sits just under the high of 358.63, only about $5.50 of excess. Value built almost all the way to the high. Clear 358, and it's thin air. into the December run. Targets. First scale around 350, tag November 18th, high 348.55, up $32, 3.2 R. Then 420, December 11th, up $102, 10.2 R. Then 480, December 16th into the 17th, up $162, 16.2 R. The full ride to 480, just over 16 R. Now, be honest on camera, that's the dream number on a $10 stop held for weeks. The realistic version is a scaled exit. A third at 350, a third at 420, a third at 480. That still nets about $9,900, nearly 10 R. Because here's the pros rule. When a move goes parabolic, when the distance from the moving average stretches way out, that's where you sell. And confirm it leg by leg. Every push-up prints a break of structure with positive CVD. The trend keeps signing its own name. Thick base, thin void, fat value. The profile drew you the map. The pullback to POC just gave you the entry.
When it goes parabolic, the distance, like you can see the angle changing, and the distance is also like quite much from the 20 moving average. This is where I sell, which is like selling into strength. And
this is the one you screenshot. It's textbook and exceptional because everything points the same way in a single bar. The heaviest volume candle in the whole window is the one that breaks the edge of value. And the moment it clears that edge, there's nothing overhead to fight it, all the way to 425. High conviction at the trigger, zero resistance to the target. When max conviction meets zero resistance, you get trade 5.
When a market moves out of balance, it auctions away from the previous point of control as it looks to find the new accepted value.
Two concepts in one. A value area breakout is a compressed spring releasing. An LVN gap surf is price racing through low volume air to the next shelf. The summer value capped at the value area high around 350 with failed pokes to 355, 358. That all got rejected. Then, September 11th, the 10 o'clock bar clears the value area high and the entire spike ceiling at once, closing at 358.90. And above 358, nothing. No prior volume in the window. An open door all the way to 425. Forrest Knight says it best.
All of my executions rely on this idea of a high volume signal candle that has confluence with an edge and a higher time frame volume profile.
Let's break that down because that's exactly what this trade is, to a T. The high volume signal candle is the September 11th 10 o'clock bar, one of the two fattest bars in the file. The edge is the value area high at 350. The higher time frame volume profile is your summer 30-minute profile, the big picture context. And the confluence, all three line up in one bar. The high volume candle breaks right at the profile's edge. That's exactly what this is, a high volume candle breaking the edge of value. There was no clean retest, September 12th gapped up. So the aggressive entry was the one that paid.
What's the 0.01?
Well, I mean, there's this little hole. It was kind of an aesthetic choice by the architect, and if you shoot a laser into this hole, the station blows up.
Whoa, 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 whoa.
Entry, 352. Stop, 344. Below the 930 low at 347.60 and back inside the value area. $8 of risk, 125 shares. The breakout principle from the ebook. Enter the break, stop back inside value. Measured move to 380, next day up $3,500. 396 by the close, 5.5 R. Here's why price raced so fast. The LVN fast travel zone is the slice of price where almost no volume traded. So once price enters it, there's nothing to slow it down. It accelerates, it surfs to the next price where real volume sits. Here's the mechanism, the auction theory version. Volume on a profile equals acceptance. It's where buyers and sellers agreed to do business and spent time. A low volume node is the opposite, a level the market rejected, blew through, or simply never used. Because so little traded there are almost no resting orders and no memory of value. Nobody's trapped. Nobody's defending a position, nothing to absorb the move. So when price re-enters a low-volume node, it travels through quickly and decisively until it hits the next high-volume node, where liquidity and acceptance resume. That's the fast travel, the gap surf, price seeking the next shelf. The intuition, a high-volume node is thick mud, lots of orders, price wades through slowly. A low-volume node is ice, frictionless, price slides right across it. In your trade 5, value capped at the value area high, 350, and the failed September 5th, 8th, and 10th spikes left a thin shelf up to 358. Once the 10 o'clock bar cleared 358, price was in open air. No prior volume in the window meant no resistance until the 425 region. That void is what it surfed, 358 to 425, with only the measured move and the intraday highs as waypoints, not real volume resistance. The next high volume node at 425, September 15th, 9R, and confirm it with plain volume. The breakout bars are the fattest in the range. Don't get greedy. You take profit at the next high volume shelf, because that's where the wall is. This strategy is top tier. A naked POC is an old point of control, a price the market hasn't returned to, and the highest win rate setup in the whole playbook is the previous POC retest. Price comes back to fair value. The original participants defend it, and you trade the first touch. Tesla left a point of control at 220 back in October, and for months it just sat there, naked, like a magnet.
Is that yesterday, this is the price where the buyers and sellers agreed was fair value. There's no reason to think at the moment, I'm assuming there's been no fresh news, which it doesn't look like it, why the buyers won't make a stand there again. Why would they get there? Happy to buy it there yesterday, why wouldn't they buy it there today if it comes down?
Here's how the best market profile traders frame it. Yesterday, this is the price where the buyers and sellers agreed was fair value. There's no reason why the buyers won't make a stand there again. They were happy to buy it yesterday. Well, why won't they buy it today if it comes down? Now drop to the 5-minute chart because this is where it gets cinematic. March 10th, the 345 bar, first touch. The low prints 220.18, landing on the naked POC to the cent.
Use the Force, Luke.
Obi-Wan?
Yeah, it's me. Use the Force. Force that thing in there.
March 11th, the 1045 bar, a quick spring, an undercut to 218.13, a stop run into the thin air below the high volume wall. Invisible on the daily, obvious here, and the 1050 bar, the reversal. One single 5-minute bar opens at 218.85 and closes at 225.71. Buyers violently defend their territory. Touch, spring, reversal. As Forrest Knight puts it, the market's 100% going to react here. There's a massive amount of people there waiting. They're waiting to take action because the price finally came back to them.
Versus here, the market's 100% going to react here, and it's 100% going to react here every single time. It has to, right? There's a massive amount of people there waiting. Yeah. They're waiting to take action because the price finally came back to them because they're super green.
The entry is clean. 220, a limit resting right on the naked POC. The first touch kisses it. Then the spring drives price straight through, and your order fills at fair value, 220, dead on. The stop is 216, below the spring low at 218.13, down in that low volume air. And that's a stop you could only justify because the 5-minute showed you the spring and the volume showed you the buyers arrive. $4 of risk. On a $100,000 account, risking 1%, that's $1,000 on the line. 250 shares. Next high volume node at 250.
Because I entered early at 904, I'm making about 20% with a stop of 2%. So for me, the same trade is 10-hour trade, and for somebody else who bought here, it's a 3-hour trade.
The very next day, that's 7.5 R, $7,500. Then 288 2 weeks later, 17 R on paper. But say it straight, nobody holds a $4 stop untouched for 2 weeks. You trail to break even after target 1, and you scale out. Even if you took target 1 and went home, $7,500 on a $1,000 risk, 7.5 R. That is a phenomenal trade. The naked POC is the closest thing to a magnet this tool gives you, and the volume flipping green on the shelf is the green light. Thank you for watching, and if you found this valuable, hit the subscribe button, and I'll see you in the next one.